On December 30th, 2025, 6 AI models were each handed 100,000 real dollars. Not a simulation, not paper trading. Real money, real market, real trades. No humans pulling the strings. Each AI picked its own stocks, set its own strategy, made its own calls. 6 months later, one of them was crushing the market. The others weren't even close. Today we find out which AI actually won, why the others failed, and what that tells you about whether AI can really beat the stock market, or if this whole thing is a trap dressed up as innovation. Here's the number that should worry you. In 2025, hedge funds had one of their best years in over a decade. Professional money managers, unlimited data, teams of quants. Their average return, 12.6%. The S&P 500, the index anyone can buy in 5 minutes, beat them by roughly 400 basis points. That's not a bad year for the pros. That's the pattern. Over the last 15 years, the average hedge fund has only beaten a plain index fund in 3 calendar years. 3. So when you hear AI is going to change investing forever, you should ask the obvious question. If the smartest humans on the planet, with every resource money can buy, still can't consistently beat an index fund, why would adding AI change that? Here's what makes this uncomfortable. It's not that these fund managers are bad at their jobs. Some of them are the most sophisticated investors alive. The problem is structural. Fees eat returns. Crowded trades cancel each other out. And the market itself is a machine built specifically to punish anyone who finds an easy edge, human or artificial. You've probably seen the headlines. AI stock pickers, AI hedge funds, AI portfolio managers. You're being sold a story. Today you get the actual numbers behind it. We're not guessing here. Everything in this video comes from real fund performance data, live AI trading experiments running with real capital right now, and institutional research from firms managing trillions of dollars. No speculation, just what's actually happening. Back to those 6 AI models. Each one got a real brokerage account, real capital, full autonomy. No human vetoing a bad trade. One model, built on a fast, aggressive architecture, pulled ahead early and stayed there, posting returns that outpaced the S&P 500 by a wide margin through the first half of 2026. The others lagged, some barely breaking even. Same market, same starting capital, wildly different outcomes. Here's the takeaway. AI is not one thing. Asking, can AI beat the market, is like asking, can a person beat the market? Depends entirely which person, which strategy, which decisions. The model that won wasn't smarter in some abstract sense. It took more concentrated, higher conviction positions. That's a risk profile, not magic. Which brings us to a bigger problem. But before that, you need to know about the one fund that actually cracked this. Renaissance Technologies. Specifically, their Medallion Fund. From 1988 to 2018, it averaged 60% annual returns before fees. Not for one lucky year. For 3 decades. A dollar invested at the start would have turned into roughly $400,000, adjusted for their fee structure. Founded by a mathematician, staffed almost entirely by physicists, code breakers, and statisticians, rather than traditional finance people. They built machine learning style pattern detection into their trading before most of Wall Street even had the word algorithm in its vocabulary. Here's the twist that matters to you. Medallion has been closed to outside investors since 1993. You cannot buy in. Nobody can unless you work there. The one fund that proved sophisticated pattern detection could consistently beat the market decided the smartest move was to keep all the profit for themselves and stop taking outside money entirely. Takeaway: when something in finance actually works at scale, it doesn't stay available to the public for long. That should change how skeptical you are of any AI trading product marketed directly to retail investors. Here's what nobody selling you an AI trading bot wants you to think about. Goldman Sachs tracks hedge fund holdings every quarter. Right now, the most popular stocks among hedge funds are more concentrated than they've been in years, a huge share of them piled into the same handful of AI-related names. When every fund, human or AI, is trained on similar data and chasing the same signals, they start making the same trades. That's not diversified intelligence. That's a crowd wearing a lab coat. Analysts have flagged this directly. Hedge fund strategies are now showing historically high correlation to the S&P 500 itself. That means when the market drops, AI-driven funds don't cushion the fall. They can amplify it because everyone's exit is the same exit. Think about what that actually means in a crash. In a normal downturn, different investors sell for different reasons at different times, which slows the fall. If AI systems across hundreds of funds are all trained on similar data and reacting to the same signals, they can all hit sell within minutes of each other. That's not a hypothetical. It's close to what happened in earlier algorithm-driven flash crashes, just with faster, smarter triggers this time. The takeaway? More AI in the market doesn't mean more diversity of thought. It can mean the opposite. A faster, bigger herd, all running for the same exit at the same moment. So is this all hype? No, but the honest use case isn't AI picks winning stocks. It's speed and pattern detection at a scale no human team can match. AI models can scan thousands of earnings calls, filings, and news events in seconds, and flag anomalies a human analyst would take days to find. That's real, measurable value. It's why nearly every major fund now uses AI somewhere in its research pipeline, even if a human still pulls the trigger. The mistake retail investors make is skipping straight from AI can find patterns fast to therefore AI will make me rich. Those are two very different claims. One is proven, the other is a sales pitch. Therefore, use AI tools for research and screening, not as a replacement for your own judgment on when to actually buy. Let's talk about the number that should actually give you pause. Over the past 5 years, AI-related stocks have outperformed the S&P 500 by more than 100%. That's an extraordinary run. Extraordinary runs are exactly when smart money starts asking uncomfortable questions. Institutional investors are now openly debating whether AI infrastructure spending, the data centers, the chips, the power contracts, is being priced for a future that has to arrive exactly on schedule, with no delays and no disappointments. There's a reason this matters more than most bubble talk. This time, the spending isn't just financial speculation, it's physical. Real data centers, real power grids, real chip factories built on the bet that AI demand keeps compounding for years. If that demand curve so much as flattens, the companies who spent hundreds of billions building for it don't just see their stock dip. They carry that capital cost on their books for years. History doesn't repeat, but it rhymes. Every transformative technology, railroads, the internet, mobile, created real value and a bubble at the same time. Both things can be true. The technology can be real, and the stock prices can still be ahead of themselves. Don't confuse "this technology matters" with "this stock price is justified." Those are separate questions, and conflating them is how people lose money on good ideas. Back to the original question, can AI beat the market? Some AI models, in some conditions, with the right risk appetite. Yes, clearly, we just watched one do it with real money. But AI, as a category, beating the market consistently, reliably, for the average person using an app. The evidence isn't there yet. If it were, every hedge fund on the planet would already be doing nothing but running the winning model, and they're not. Because the winning model today can be the losing model in the next downturn. Remember, Renaissance technologies proved decades ago that it's possible to build a system that consistently wins. They also proved that once you find that edge, the rational move is to close the door behind you and stop letting anyone else in. That single fact should tell you almost everything about how much of the AI will beat the market for you. Pitch is genuine, and how much is a product trying to get funded? The honest answer isn't yes or no. It's AI changes how fast decisions get made, not whether the underlying game of investing is still about risk, timing, and discipline. Speed is not the same thing as an edge, and an edge that becomes public stops being an edge. So, 6 AI models, real money, one clear winner so far. Not because it was smarter, because it took more risk. That's the whole story of AI and investing in one sentence. It doesn't remove risk. It just executes your risk appetite faster than you can. And the one fund that actually built a real, lasting edge with these methods didn't sell it to you. It locked the doors and kept it for itself. If you're going to use AI tools in your own investing, use them to research faster, to scan more filings than you'd ever have time for, to catch things a tired human eye would miss late on a Sunday night. Just don't use them to skip the thinking part. That part was never the bottleneck technology could fix. If this helped you cut through the noise, subscribe. Every week we break down where tech and money actually collide, with real numbers, not